What's up, YouTube?
And we are live for our fourth live stream, our weekly live stream at 4:15. This is following our new video that just dropped on LOIs, commitments, and condition of financing.
Super important stuff.
Yeah, we decided initially we were going to make this video specifically because there's a lot of misunderstandings about what each individual document has and why they're important and what they mean to you. So we thought it would have a ton of knowledge, and it would kind of just teach people a little bit about the process and what each individual document meant. So we're just going to review kind of the content that we went over in that video, and obviously feel free to watch our videos on YouTube. We would love the engagement. If you just want to press the like button, press the subscribe button. We're trying to hit 100 subscribers at the moment. We are very close. We have 5 left. So I guess we can start with letter of intent. So a letter of intent is basically an offer from a lender saying that they are interested in your deal, whether it's a commercial deal or a private residential deal. It's basically a letter saying, you know, this is who we are, this is what we could possibly offer on your deal, we're interested in it, and we would like to move forward. And sometimes that letter of intent has a rate, it'll have a term, it'll have the outline of roughly what the loan is going to be, and then it'll tell you about the rate a little bit. This isn't a concrete rate, and it's not concrete mortgage terms, so it's not something that you can sign and hold and just expect that's going to be the definitive contract that you're going to be moving forward with. But it's almost like a discussion letter. It is super important because it kind of sets out the terms in which you're going to be interacting with the lender. And usually it's given on either like a large private loan,
typically on a commercial deal.
Or a commercial deal.
Yeah. The main thing with the LOI is just to set out some expectations moving forward. The LOIs are going to have some very preliminary conditional conditions that have to be met before they're really going to move forward and provide a commitment and a full approval on the deal. On income producing properties, the main thing they're going to be looking at is going to be an NOI, what that net operating income is of the building. And essentially they're looking at the debt service coverage ratio from their end, just making sure that building is able to sustain itself and debt service itself. Other than that, some of the other basic conditions that are going to be on an LOI are going to be an appraisal, just making sure that the value is there in the property. If it's a commercial building or a large multifamily building, there's going to be a phase 1 potentially needed, and environmental, just to make sure there is no contaminations in the ground. Anything harmful to the tenants obviously would be an issue moving forward. And then a building condition report, which is just as straightforward as it sounds, making sure that the building is in a safe condition and is going to be able to have some sort of acceptable lifespan for the lender. Those are really the big conditions that are going to be on there. Other than that, some of the other conditions that you're probably going to see in an LOI, they're going to want to know what sort of arrangement the purchase is being made in. So whether that's in a holding company or whether it's just in a personal name, who's going to be coming on title, just the general structure of that. Very basic stuff. And then after those are all met and we're able to provide the documents, the lenders are able to take a look at it and then move forward with a full commitment letter provided with the last financial or the last outstanding conditions that we can check off before the actual funding proceeds.
Yeah, so sometimes also this is the point in which you're going to have to take the next step in actually moving forward in the process. So once you get your LOI, they are probably going to ask for some sort of deposit. If you're serious about moving forward with your purchase, with a private lender or an institutional private lender, some have a $5,000, some have a $10,000 deposit. So this is the moment where you decide if you're going to be moving forward or not going to be moving forward with your loan.
Yeah. One of the benefits of working with more reputable and experienced mortgage agents is that they are able to distinguish between the lenders who will actually move forward after having that retainer fee or that good faith fee that they collect, versus those lenders who are just out there to collect the fee and then later on tell you that you for some reason you don't fit their lending criteria, which does happen. But there are very legitimate lenders out there who will collect a good faith fee and then still move forward with the deal. And one of the things to look for is just, if you're doing some research on your own, check their overall and past funding volume. If they have a high amount in previously funded deals, that's a company that's going to be able to move forward and actually follow through on the LOI and the commitment that they provided.
Yeah. A reason why a lender might ask you for a deposit on a larger loan, specifically because they start engaging their lawyer in a handful of different checks when they're moving forward in the process. So obviously when you have a lawyer, you have a retainer fee on that lawyer, and they start incurring costs as soon as you execute on that LOI. So it's important to note that sometimes even if you don't move forward with the loan, you might get a little bit of it back, but I would recommend that if you're going to make that down payment or deposit, I wouldn't expect it back, because they are moving forward and hiring people to be able to start processing your loan.
Yeah. If you guys are if the deal doesn't go through for any reason, other than for some reason the lender decides that they can't move forward with it, most likely that deposit is gone. So like Josh had mentioned a little bit earlier, you guys really got to be certain that you're ready to move forward with that specific deal before you guys put that deposit down.
Yeah. So the next step in the process, once you have your LOI signed and you guys have moved forward and you're ready to engage with the lender, is going to be your actual commitment. The commitment is going to be a little bit more in depth. It's going to have the official mortgage terms that are going to be registered on title. It's also going to outline exactly what the lender is looking for in regards to documents and in regards to what they need to close in the transaction. So this document is a legal binding document. This is the document that's going to bind you between the borrower and the lender. It is very important to have independent legal advice when you are taking a look at this document, specifically because you are signing something that is legally binding, and it could have ramifications if you don't quite understand how the document or how the mortgage terms are laid out and how they work. This document is going to have all the basic things the LOI had. So it's going to have your rate, any broker fee or lender fee involved. It's going to have your term. So how long is the term? Any requirements that they have in regards to additional documents. So building condition reports, as Aaron said. You're going to have environmental reports. So if they need a phase 1, does the phase 1 come back clean? You're going to need an appraisal. And there's a handful of things. So these lenders will also sometimes put these specific appraisers that they want to use or that they have on like a list. So those appraisers that they have are trusted appraisers that they use and that can verify value for them. Other than that, I would highly recommend, if you do have a mortgage broker, that you go through specifically every piece of that document with them. It's important that you understand the documents that you're signing, especially when you're purchasing large commercial property or private loans. They're there to protect you, but they're also there to protect the lender as well. So it's important to really understand how those agreements work. Other than that, you're going to have a handful of documents to go with your commitment. The standard, consent form. You're going to have a disclosure form. That disclosure is going to outline all the fees associated. So the broker fee, the lender fee, any appraisal fees, stuff like that. It's also going to have your amortization schedule. It's going to break down all of your payments and what that looks like over the term of your loan. It's also going to break down a little bit of a disclosure on our end. So we're going to explain to you, some of the risks associated with taking on large amounts of debt, why that might be important to you, and some things that you should take into consideration before signing your documents. And lastly, it's going to have a letter of direction. So when we obviously complete transaction, we also get paid as well. So that letter of direction will be signed and sent to your lawyer's office.
Mm-hmm. And we know there's a lot of you guys out there who have been investing for a while and have gone through probably the mortgage closing process, a fair bit of times. And it might seem redundant to continuously sit down with a mortgage agent and go over the commitment, but underwriting guidelines and bank guidelines change all the time. Especially in this past, year with COVID, we've seen a lot of changes happen. So you could have gotten a mortgage in December or January and are getting a mortgage now, and some things have changed. So that's why we like to sit down and just go over the details with all of our clients and with every single mortgage package. And sometimes there's things in there that you may not have known, and maybe the mortgage agent that you had before wasn't experienced enough to make sure that you knew those things. So, even if you have the same mortgage commitment or a mortgage commitment with the same lender, maybe the guy that you were with before forgot to disclose some things and go over some things. So, it's always good to just sit through and just listen. And if you have any questions, make sure you ask them before moving forward and before signing.
For sure. I guess the next on the list is really condition of funding. So this is something that's super important that a lot of people don't understand. And this is basically the time in which you would waive your financing when you have a purchase agreement, and what the conditions on your commitment actually mean and how they work with you. So in a nutshell, there are a handful of different broker conditions and solicitor conditions required to close on a transaction. Those conditions can be anything from income verification documents to documents pertaining to the actual property and everything in between. So what's going to happen is when you go through your document package with your broker, we're going to go over all the things that we require to be able to close a loan. Those are called conditions to financing. We need to make sure that all those conditions are met before the funds can be transferred to you and to your lawyer. So when you waive your conditions to finance when you are purchasing a property, you're technically saying that you can fulfill all the conditions on the commitment. And a lot of people, what they'll do is they'll get a commitment and they'll be like, oh, okay, I got a commitment, we're good, I can waive my financing. Well, it's a little bit deeper than that. And it's really important for you guys to understand that once you have a commitment, that commitment doesn't mean anything if you can't fulfill the conditions required to fund the deal. So it's really important to understand that that those conditions are not like something that we can just kind of brush by. Those are required to close on the transaction.
Mm-hmm. And guys, you got to remember too, if there's 10 commitment or 10 conditions on that commitment, sometimes those conditions can be broken down further. And we see that a lot with borrowers who are business for self and self-employment. Some of the conditions are very generic. So, confirmation of income. That confirmation of income can be broken down into a handful of other little conditions that might require, additional documents other than what you've already handed in. Sometimes it may ask for T5 slips, or if you have your own company, maybe they're going to look at retained earnings in the company, business statements. They may look at your own T1. So those conditions can be broken down further. So sometimes it can be frustrating when you feel like you're continuously handing in documents and the banks are just coming back and asking more and more questions. But the banks are doing these, asking for more of these documents because for some reason the previous documents you have hasn't quite fulfilled their satisfactory level of risk. So if they need to see something further, they have the right to ask for that additional documentation, and that's something that we have to provide to be able to move forward with the loan.
Yeah. What to keep in mind, and we can break down like different what do you want to call it? Different types of conditions. So the first is going to be income. What are we going to need for income? We're going to need income documents. So it depends on really how you're employed. So if you're a salary employee, we use your letter of employment, your pay stub, to verify your income. Some lenders are requiring that we have a bank statement to show the most recent transaction coming from your employer in your bank account, just to show that you are currently still employed on closing. If you are an hourly employee, we use 2-year average of your T1 generals and your notice of assessments. So we're going to require letter of employment, a pay stub, 2-year T1s, 2 years NOAs. That basically allows us to verify you're currently still employed, you're getting paid, and I can find the average of the 2 years that you made, and I can make sure that you don't owe any money to the government, which is super important. Now, in regards to the letter of employment, are you on probation, which is probably one of the most important things. So if you're on probation, let us know before you submit your application. That is super important. Most lenders don't allow you to close on a deal if you are still on probation. In regards to the property, the subject property, we'll call it subject property, which is the property that you are coming to us for financing. It could be your house that you currently own, you're trying to take financing out, or purchasing a new one. The MLS, if you're purchasing, the agreement of purchase and sale, if you're purchasing as well. They are going to require, so for the MLS, they're going to look at the property taxes that are listed on the MLS, and that's how they're going to verify that. On the purchase agreement, they're obviously going to get the loan amount from there, because that's how much you locked in your financing for and what you want to pay for. And if you're refinancing, they're going to require a few things as well. They're going to require your up-to-date property tax statement just to verify you aren't behind in any property taxes. They're going to require a current mortgage statement from your current mortgage company just to see exactly how much you guys owe left on your mortgage. And last but not least, they're going to require an appraisal. So the majority of properties or transactions require appraisals. So it's important that we order the appraisals and not you guys. There are a handful of different requirements for each lender, and each lender has a list of appraisers that they use. So if you go ahead and order your own appraisal, you might actually shoot yourself in the foot and not be able to use that appraisal. So it's really important to just go through your broker first.
Yeah, definitely. We had a question coming here from Thomas Forsyth. Question was, how do the banks look at income from having billboards on top of the building? That obviously generates some income. So it's a good question. This is most likely going to be something that would be used on a potential like commercial side deal. Obviously, you guys are going to have billboards on top of your primary residences. So in most circumstances, when banks are qualifying you on your personal income, they're looking strictly at CRA government documents, stuff that you are claiming your taxes on. So that's going to be some sort of salaried or business for self type of income. Now, if you are purchasing a commercial building and there are other sources of income generating in, such as like solar, some sort of advertising, sometimes coin operated laundry can be in there as well too. Those sources of income can be taken into consideration when the appraiser is looking at a income producing approach method for the appraisal. So sometimes those methods of payments and sources of income can be considered in those situations. But when we're looking at a straight residential deal, 1 to 4 unit, banks aren't going to be looking at your advertising or your coin laundry. They're just going to be looking at either your personal taxes or what you're making in your operating company if you're self-employed.
And that's specifically because on a commercial property, most people who own commercial property have them in a corporation, and they can show history of the income on the property. So if you can show the history, most banks look for at least 2 years history to use any verifiable income. So if the seller, for example, has their books and they can show consistent revenue coming into that company that you have that owns the property, we can then probably take a look at it. But if you have heavy reliance on some income coming in for other than the actual rent on the property, it's probably not going to work.
To sum it up, really, in terms of the residential purchases, they're really going to want to have tax verified income. There isn't really a way to submit, income being received from your billboards as some sort of like tax approved document. And that's really where it kind of gets, that's really where the determining factor lies with being able to use the income. So.
Perfect. Yeah. So, the next topic, we can really just talk about some stuff we've seen in the market this week. We've kind of run into a bunch of crazy stuff, and we started kind of jotting some stuff down as just like situations that we just don't run into, and then we run into them. So we thought we'd share them with you guys. What's some crazy stuff that you had to deal with this week?
Crazy stuff I had to deal with this week, guys. If you are building a home, make sure that the closing date is not the date that you expect the home to be completed. This is very important for 2 reasons. One, the lender is going to want an appraisal done to confirm that A, the value of the property is there, and 2, that the property is 97% complete. This is important because that 97% complete mark means that the home is livable. One of the things that we're seeing right now with COVID is just, a delay on getting materials or a lack of available building materials. So I had a client who was looking to, they were building a home, and the builder was just delaying back the completion date closer and closer towards the actual funding date. It was already set to be completed 2 days before, but he essentially took the last 2 days. So, and with the way that the builder had determined the property value, it was determined by using the cost of all the building materials inside the home. So because there was some delays in getting things done, we had to get the banks to allow us to have an exception to send out the appraiser the day before to confirm the value. So just make sure that you guys give yourself some time to be able to get the home completed. Allow an appraiser to get out there at a 97% completion, verify the property value, and let us get that back to the lender in time to be able to move ahead with funding. So something to keep in mind, just the economy and what kind of changes are happening. If you're currently building a home and you're seeing delays, maybe talk to a mortgage agent about, maybe pushing the date back. And if that's possible, just to allow yourselves a little bit of freedom and not having to stress and make sure things get pushed through and rushed.
For sure. Touching on current climate in the mortgage market, one of the things that we're seeing a ton of is just setting expectations for your refinance. If you guys are looking to pull some equity out to do whatever you want to do for investments or to purchase another property, setting that expectation of how long it's going to take to do it. Currently, we're looking at a month and a month and a half. Response times are down significantly on the lender end. So it's taking a little bit of time to be able to get back to us. So being able to structure, your plans and what you're doing. If you have like a refi and you have a purchase that's closing a week after your refi, make sure you tell us, because, setting those guidelines to be able to execute properly on your transaction is going to be super important. Because if we don't know, then, 2 or 3 weeks before closing, we're going to have a problem, which the last thing we want is to do that. So just letting you guys know that currently it's backed up at the moment, but we are working our best to be able to make sure that you guys are getting your transactions completed on time. Oh, we have somebody coming on here on Facebook, Ryan Clark. What was the $20,000 for any property all about? We'd be happy to share that with you guys. Aaron, you want to start?
Yeah, guys. So we have picked up a new product for flips, and it can be used for burst strategies as well too. It is a private mortgage, and they have basically found a way to reduce entry into a purchase. So they have changed their minimum requirement for a down payment from 20% to $20,000. Basically, after the $20,000, they will give you a mortgage for the rest of the purchase price up to 80% of your suspected ARV value. And like I said, this is meant to reduce entry costs. So it does come with a little bit higher carrying costs. So the interest rate is 15.5% over 6 months. It's a fully open, no exit penalty, 6 months term. There is one upfront fee, and it's 2%, but it's built in quite interesting. So 1% of the fee is paid out ahead of time, and then the rest of the fee is actually built into the mortgage. So you don't have to pay that out until on the back end. So it actually reduces your upfront cost even further. All they really want to see from you guys is a couple things. One, that you guys have some sort of liquid funds to be able to cover the renovation. So they want to see credit cards, lines of credits, a promissory note, cash, or some sort of options from a joint venture partner. If you guys don't have the funds, or if you're short funds, and you have another property that has some equity in it and available, they will actually be able to put a collateral charge on that non-subject property, your other secondary property, and lend you some money to be able to complete your renovations. They only qualify you guys once a year, which is super interesting and allows you guys to kind of move forward with expediency. So like I said, once a year, what they're going to take a look at is a credit check. And they're going to do some basic due diligence. So credit check, they're going to take a look at an NOA or a T1 just to see what your income is like. They're not qualifying you guys based off of your credit score and your income. They just want to understand what your financial situation is. And once they verified those and they have the application that we have for our lender submitted and approved as well too, like I said, you guys are good to move forward. And then any other products or purchases that you guys want to bring to them, they've already done the approval for that year, and you guys can move swiftly into the funding phase.
Yeah, that is the product in a nutshell. We've had an overwhelming amount of people reach out and start getting set up with this. What we're doing is we're just asking you to either go on our website and fill out an application. That application will then trigger us to be able to contact you. We do have an application which Aaron talked to you about. It's a credit application internally for them, and we also have a flip analyzer spreadsheet. This spreadsheet's going to allow you to crunch the numbers and see if your ARV is actually viable and if you're going to be profitable and make money. Mm-hmm. At the end of the day, our partner that we're working on with this, their main goal is to make sure that there is money to be made. If it's not money to be made, if the difference between you making money and not making money is 1 month, we're probably not going to do the deal. We don't want you to take on a job. We want you to take on an investment, right? Mm-hmm. This is an active investment. So it's a phenomenal product. If you guys have any other questions about it, just feel free to reach out. we're taking calls, we're setting up appointments. So if you do need it, let us know. They are making moves, changing the market, blasting through barriers.
And it's important to remember, it is just for residential property. So it's 1 to 4 units. Now, if it was a 4-unit or, a 3-unit and you guys wanted to add an additional unit, that's totally doable and can be done. Again, just set those expectations out with us beforehand, and we can talk to you and then have a conversation with the lender as well too, to make sure they're good to go ahead.
Yeah.
Other crazy things. If you guys are looking to do a renovation to your property, kind of following up with that 97% completion, it's important to make sure you guys refinance the property first before you're in the middle of a renovations. Essentially, if we send out an appraiser and the appraiser sees that there's a secondary unit being built, or the basement is under construction, and they are unable to show that the house is 97% complete, 99% of the times the lender is going to have a lot of red flags and are really going to push back in terms of putting out financing on that property. And it really comes down to just risk and safety to the lender. They don't want to be stuck with that project, very similar to that private product that we just talked about. So if you guys are looking to do renovations, make sure you come to us first and beforehand, and we can get that equity taken out prior to, because the chances of you guys being able to get that refinance done in the middle of renovations are very slim without having to go into some sort of private secondary financing.
Yeah, which could be decently expensive and definitely cut into your bottom line.
Mm-hmm. Something else I think is probably something that we're probably going to do a video on coming up as well too, but we'll touch base on it quick. If you guys are looking to purchase income producing properties, specifically more in the multifamily and larger commercial stuff, we understand that you guys are looking to purchase properties vacant because it allows you to go in and make some changes. But it's important to consider, just going back to that, the LOIs that we were talking about, and how one of those conditions is going to be that they want to see the net operating income working at a certain debt service ratio. Having those vacancies and a large amount of vacancies beforehand can affect your application moving forward. And even though the building and the fair market rents and the possible rents on that building are probably in an A position, if that NOI isn't currently in place at the time of purchase, you might be looking at a private product to be able to get you into the purchase and then allow you guys to get your renovations done, get the rooms tenanted out at your high rent level, and then refinance back out on the A side. So again, if you guys are looking to make a commercial purchase, make sure you just reach out to us first with the numbers. Let us take a look at the debt servicing ratios and the net operating income and make sure that those numbers are going to be in line, because the last thing that we want to do is kind of move forward with when you guys should really be in a private, and we just kind of waste a lot of the time moving forward in the wrong direction.
Yeah, something you touch on with that commercial refi as well is CMHC does allow refis, although there are a handful of guidelines that most people aren't aware of. Everybody wants that CMHC, super low, like high 1%, low, medium 1% rate. Those rates, they're phenomenal, but they do come with a few limiting guidelines that a lot of people aren't aware of when they want to pull equity out of a property. So, we're going to start pushing a ton more commercial or multifamily content out starting next month. We're really looking forward to being able to kind of dive deep and let you guys know exactly what that looks like in regards to, somebody wants to join our stream. All right, let's see what we can do. I don't know. Do you have a question? We're waiting for... While we wait, there was a question that was... Oh, here we go. Joining our stream. Hello? Oh, he's gone. Unfortunately, he's gone. Here we go. We have another question from Watts. So if I own properties in my personal name and want to move them into my corp, how do I do that without incurring land transfer tax? Any tips? You can't.
Yeah, you're stuck, unfortunately. And that's, that's something that you guys really have to consider beforehand. And it's tough because if you're purchasing properties in a corp that are residential, there are a lot of lenders out there who don't want to deal with holding companies. So you really have to make that decision ahead of time. We understand what you guys are looking to do in terms of being able to keep your debt ratios open and allow you guys to move into more properties down the road. But there is a decision to kind of be made there. If you guys are trying to skirt around, maybe not skirt around, but make sure you have more lenders available to you by purchasing into your personal name and then looking to transfer that into a corporation. You guys are going to be paying the land transfer tax for that. So just something to keep in mind. Obviously, it can be an advantage moving forward, but you have to be in that financial position to be able to, pay that tax and move forward with that. So.
Yeah, so for people who don't know, actually, purchasing property through a corporation does have its advantages. When you purchase a property through the corporation, you are, in essence, a director of the corporation, whether it's yourself as a sole director or multiple people. Say Aaron and I would be directors equally owning the corporation. Now, why would somebody do that? Well, somebody would do that because when you make a loan, the applicant or the main applicant is going to be the corporation. And then the directors or the guarantors, so people who are going to give a personal guarantee are going to be yourself or the people who own the corporation. Now, you limit yourself residentially when you're trying to find a lender, specifically because most lenders, as Aaron said, don't like lending in a corporation. But on the positive side, when I go to pull your credit bureau, the debt that you have, the mortgage debt doesn't show up in your credit bureau. So it allows you to personally qualify for more because you're not 100% personally liable, although you are. But there are obviously advantages to holding real estate in a corporation. Although most people that it would be most advantageous to would be people who are flippers. Go talk to Pierce and the guys at Galleon. Those guys know exactly what's up, and they'd be able to help you structure whatever you need to do. There are ways in which you can have tax advantage to corporations when you are purchasing and selling real estate. A
little caveat to that too. When the properties are purchased in your corporate structure, as the personal guarantee, your name isn't supposed to be registered or having that proper registered to your name. There are some fluke circumstances that happen where sometimes when we pull a credit bureau, those mortgages do show up registered under your name. So there isn't exactly a reason, and it must be something that happens on the land registry side. But, there is a 1% chance for some reason that does show up under your personal liability. So if a mortgage agent does let you know that has happened, just kind of keep that in mind that every once in a while there is something that kind of slips through, and for some reason it does show up on your personal liabilities. It doesn't happen very often, and like I said, it's a pretty small chance. But we do run into it once in a while where something that's registered in a personal or a holding corp does show up on the personal liabilities for some reason.
Aaron and I would recommend that if you are purchasing commercial real estate, highly recommend purchasing it through a corporation. It doesn't affect your ability to be able to go to a lender or have your options for a lender, because most lenders, almost all the lenders for commercial real estate, expect you to be purchasing it through a corporation, specifically because usually people who are purchasing multifamily are corporations, or they're running it as a business, right? It has net operating income, it has some sort of capital, it has expenses. So, they're going to treat it as such. So it's just two very different types of real estate and two different types of structures that both have their positives and negatives. So something to consider.
Liability reasons behind there as well too. But Ryan Clark is just asking, how much is the land transfer tax? It's not a specific amount. It does depend, obviously, by the city and the property that you're purchasing. So we do have a basic calculator that we can provide an estimate, but it is very much specific to the transaction, so it can vary.
Yeah. Ryan also had another question: is how will the new lockdowns impact the market? If I had a crystal ball, I would love to tell you, but in our experience, I guess we can speak about the last lockdown and what happened. What happened during the first lockdown, there was a lot of uncertainty in the market. Private capital dried up. Everybody tried to keep their money to themselves. They didn't know what was going to happen. They didn't know how house prices were going to be impacted with the market. I don't know necessarily if the next lockdown, for example, is going to be as intensive as it was the last one. I think the economy is better suited to be able to deal with whatever we need. The government is able to provide stimulus wherever it may be required. In regards to real estate, I have my own hunch as to what's going to happen. I think as you see small businesses start to fail because of the lack of income coming in. I could see there be higher vacancies in retail commercial property, and because there's high vacancies in commercial retail property, the value of commercial property is derived from the operating income of the property. So if you have high vacancy, the value of your property is diminished. So if you have widespread vacancy, then I can see the value of retail commercial property being impacted, or seeing a decent chunk taken off on a discount. There was something called a COVID discount back in March and February. Yeah, February, March, and April. Basically, what was happening is most lenders were taking a look at the properties, and they were giving some sort of discount. Some of them were giving about 20%. Some of them were giving 15% discount on value to be able to lend. So they were basically only lending. So if they were going to be 80, then they would be at like 65% LTV, just to cushion whatever hypothetical impact was going to happen. So, I mean, there are a handful of different things that I could possibly see happen in the market in the short to midterm. But in regards to residential real estate, it's hard to say. Go ahead.
I was going to say, I think one of the things that investors, what you should really start doing, what everyone should start doing, is just looking at how migration is currently working in Ontario. We're seeing a lot of people move away from the GTA area. Obviously, the GTA area isn't going to die off, right? Like, the GTA is going to stay a very strong area. And once COVID starts to settle down and the government gets their stuff together with the vaccines and whatnot, things are going to start to go back to normal. But taking a look at, if people are, considering moving away and moving away from the GTA and they can work from home, maybe that changes the area and where you're looking to invest in properties. So, if you're holding properties outside of Milton, Mississauga, like Guelph area, Oakville, in and around the GTAs, you're probably going to start to see price and home values increase in those areas, just with people migrating away from the GTA. Now, what is that going to do with home values in the GTA? We could see a dip. It's hard to say how much the value market is going to be affected in Toronto and the GTA. I think it's really going to matter on how long this COVID environment continues for. But we've already seen rental rates starting to drop in the GTA area and a bit of a rental discount. So we could potentially see a bit of an opportunity to get in on a discount in properties in the GTA. And if properties do start to take a dip, we know that those properties are going to go back out. Toronto isn't going anywhere. GTA isn't going anywhere. People are going to start to migrate back. So it could be an opportune moment for people to kind of get in on a little bit of a discount into some properties, and then realize that property appreciation maybe in the next 5 to 10 years afterwards. So could just change your strategy in terms of where you're targeting.
Yeah, we're going to take a question from Instagram. It said, would Credit Karma work for checking if a personal guarantee is registered to an individual directors? Yep. So I think Credit Karma actually pulled from Equifax, but I would recommend just going to Equifax, to be honest with you.
Credit Karma is TransUnion, I believe.
Is it? Okay, yeah. So go to Equifax. I think it's free, or it's like $10 or something like that. You can pull it there. It'll show all the monthly debt obligations that are registered to your personal name, and it would show up, and you'd be able to take a look and see if it does show up or it doesn't show up. We have Vibu who actually asked a really good question. Said, how can I apply for land transfer rebate after purchase of property if I plan to move into my rental property and claim it as my principal residence? If I understand this correctly, your land transfer tax rebate as a first-time home buyer is done at the lawyer's office, and it is done automatically. So if you didn't get that, I would talk to your lawyer. Usually your lawyer, when they have a conversation with you about purchasing a property, they're going to explain to you that the land transfer tax rebate is there for all first-time home buyers up to $4,000. So if you didn't get that, talk to your lawyer. I'm not too sure about the process if you don't claim it during the transaction.
Mm-hmm. Yeah. No, it's a good question for sure. Another question?
Use Borrowwell. Oh, you're just saying use Borrowwell.
Yeah, Borrowwell I know does for Equifax. Now, something to consider on these credit applications that you can get on your phone. Two things. The majority of the time, I know we have a lot of people who will say, like, my Borrowwell score or my Credit Karma score. Most of the time, these apps are doing some sort of soft ping. So basically, it doesn't count as a hard pull. So you're not taking any true hits against your credit that would affect your score. One thing to consider with the soft pings is that it's a very random moment. So your credit score could fluctuate greatly based on when that soft ping happens. So for example, if you had just made a big purchase on a credit card that you were going to plan to pay off at the end of the month anyways, but they had pinged it right as you loaded it up, the availability and the amount of credit that you have registered is going to be a lot higher than what it was before you had put anything on that credit card. So you may see a decrease in your credit score. And then to the opposite of that, maybe you had just paid off a credit card and you were used to kind of seeing your score beforehand. If it pings it directly afterwards that you've paid off that credit score and now you have a larger total amount of credit available to you, you may see a lower score. So there can be some very large differences in between those credit apps that you can have on your phone. So just keep in mind that they're there for a tool, really just to monitor your credit score and make sure that you're not seeing continual drastic decreases, or if you're looking to improve, just noticing over time that it is starting to improve slowly. So they aren't finite credit scores, and they can change when a mortgage agent actually goes to pull your credit score.
Yeah. I mean, land transfer, one of the criteria for the rebate is that it had to principal residence, even if it's your first property. Okay, Vibu, it sounds like we're going a little bit into detail into your current situation. Feel free to give us a call. We'd be happy to just run through your current situation. And I can't unfortunately give you an accurate answer if I have 4 sentences and little bits and pieces. So if you want, feel free to give us a call. My contact information is going to be either down below, or if you're on YouTube, go to Facebook. Our phone number's there. We'd be happy to chat. Other than that, guys, we're working very diligently on creating this following organically. We actually just hit 800 followers today on Instagram, so thank you guys very much. This path to growth is really exciting, and we are excited to be on this. Give a shout out to our media team, actually, the Click Media Group. They do a phenomenal job. They tailor all of our content for us, and they have a strategy that really helps us grow our following. So if you guys are interested in either doing it personally or professionally, I highly recommend reaching out to either one of them. You can either reach out to us. We'd be happy to share the contact information. One other thing is we're always trying to make our process easier and better and more efficient. We are planning on growing and having a absolutely massive 2021. So if you guys can think of anything that you would need from us in regards to making the experience even better, or some products and services that you think are missing on your side, feel free to let us know, because we are going to try to ramp up what we're doing in regards to our content creation and in regards to our business and our process. So we're looking forward to having a gigantic year with all of our partners as well. So again, if you guys need anything from us, feel free to reach out, because without you guys, we wouldn't be doing what we're doing. So we appreciate you. Yeah.
And I think, kind of getting down to the end of the year and trying to wrap things up. One thing we'd probably love to see from a lot of you guys is just, some sort of reach out from you guys. And I don't know if we'd be able to schedule a phone call with everybody, but if you guys have some big goals coming up from the new year, definitely feel free to send us like a Facebook or an Instagram message and just let us know what your goals are. And sometime down the road, we can look at booking a call with you, or just have a conversation and figure out what we would have to do to make sure you guys are in the position to be able to meet your goals. So whether that's, purchasing your first rental property, or scaling from 2 properties to maybe 5 or 6 properties, or maybe you have a large rental residential portfolio and you're looking to start moving into the commercial section, just shoot us a message. Let us know what your goals are, and we'll try to reach out to some of you guys and just set up a conversation and maybe help you guys just align yourself with your goals for the new year. So, we have a few months coming up. Like I said, if you guys are looking to make some big moves in the new year, maybe start reaching out to us, and we can do what we can to make sure you guys are in the right position to align yourselves with your goals.
Perfect. All right, guys, have a great night.
Cheers, guys. Bye.